6 straight winning weeks. Let me say that again. 6 consecutive winning weeks. For the S&P 500 and the Nasdaq. That is the longest winning streak since 2024. Last Friday, the S&P 500 closed at 7,399, the Nasdaq hit 26,247, both at fresh all-time highs. And right now, if you're watching the financial media this Monday morning, you are going to hear one thing over and over again. Asterisk, asterisk, the rally is back. The bull market is unstoppable. AI is going to the moon. Asterisk, asterisk. And here is what I want to say to you, right at the start of this video. Fade hat is exactly when you need to be most careful. Asterisk, asterisk, not because I am a permabear, not because I am predicting a crash, but because 6 consecutive winning weeks, in the middle of an ongoing war in the Middle East, with oil above $100 a barrel, with inflation reaccelerating, and with the single most important earnings report of the year coming in 9 days, that is not a signal to go all. And that is a signal to feign understand what you are walking into Fay. And that is exactly what I am breaking down for you this morning. If this is your first time here, Fay subscribe right now, Fay before you forget. Every Monday morning before the market opens, I give you the real data, the real risks, and the real opportunities, so you can walk into the week with a plan instead of a prayer. Hit subscribe, and let's get into it. Let's set the table, because context is everything, and most people watching the market right now don't have the full picture of what just happened over the last 5 trading days. Last Monday started ugly. The UAE intercepted missiles believed to have come from Iran. The Dow dropped 557 points, falling 1.13% to close at 48,941. The S&P 500 slid 0.41% to 7,200. Oil spiked hard. West Texas Intermediate crude jumped 4.39% to settle at $106.42 per barrel, while Brent crude surged 5.8% to $114.44. That was the bad news. Then Tuesday came. Oil pulled back, earnings surprised to the upside. Defense Secretary Pete Hegseth went on record saying the ceasefire certainly holds. The S&P 500 rose 0.81%, hitting a new all-time high at 7,259. The Nasdaq gained 1.03%, touching its own record at 25,326. The Dow added 356 points. Then Wednesday, then Thursday, then Friday. By the time the closing bell rang last Friday, the Nasdaq had risen 4.5% on the week. The S&P 500 added 2.3%. The S&P 500 closed at 7,399, the Nasdaq at 26,247. Both fresh highs, 6 straight winning weeks. The longest winning streak since 2024, on the surface. Beautiful, clean. The kind of chart that makes retail investors feel like geniuses. But I want you to sit with something for a second. Last Monday, one piece of news out of the Middle East dropped the Dow by 557 points in a single day. Then 4 days of green erased it and pushed us to new highs. That is not a stable market. That is a Fay razor, thin market Fay, one headline away from a massive move in either direction. And the headlines this week, there are several that could trigger exactly that. Let me walk you through each one. I want to spend real time on this, because I think most retail investors are dramatically underestimating how complex the Iran situation is and how much of the current rally is built on an assumption that could collapse in 48 hours. Here's the background you need. On the 7th of April, Trump announced a 2-week ceasefire with Iran, mediated by Pakistan. Iran agreed. The ceasefire was supposed to include an immediate opening of the Strait of Hormuz and a framework for a peace agreement. That ceasefire was subsequently extended. Peace talks happened in Islamabad. Both sides reported progress, but here's the critical detail that financial media keeps glossing over. The US president said most points were agreed to, but the only point that really mattered, nuclear, was not. He described Iran as unyielding on the issue. Iran's foreign minister said an agreement was just inches away, but criticized maximalist demands from US negotiators. Inches away, after weeks of talks. With oil above $100 and the Strait of Hormuz still not fully open. Now here's what makes this week specifically dangerous. The 1-page, 14-point memorandum of understanding being negotiated between Trump's envoys, Steve Witkoff and Jared Kushner, and Iranian officials would declare an end to the war and start a 30-day period of negotiations on a detailed agreement to open the strait, limit Iran's nuclear program, and lift US sanctions. That MOU has not been signed. Iran is still reviewing the US proposal. No further formal talks have been confirmed. And last week, even as the market was rallying on peace deal hopes, Iran exchanges in the Strait of Hormuz led geopolitical watchers to warn that a complete collapse of the already tentative ceasefire was looking increasingly likely. The question of the week is whether geopolitical risks will remain messy but contained or break through to weigh on markets and corporate earnings. According to Tina Fordham, founder of Fordham Global Foresight, that is the question I want you to hold in your mind this week. And here is why it matters so much for your portfolio. The market is currently pricing in a peace deal that doesn't exist yet. Every day the S&P 500 is at 7399 with oil at $102. The market is implicitly betting that the Iran situation resolves. If it doesn't, if talks collapse, if another missile exchange happens, if the strait remains closed through June, the repricing will be fast and it will be violent. We saw the preview last Monday, 557 Dow points in one session. Now imagine that happening with the market at all. Time highs and retail investors fully positioned for continued upside. I am not saying that is what happens. I am saying that is the risk you are carrying right now if you are long this market without understanding the geopolitical bet embedded in your positions. Pause before I move on. I want to ask you something directly, and I want you to answer in the comments. How are you positioned heading into this week? Are you fully invested, holding cash, or somewhere in between? Drop your answer below. One word is fine. I read every single comment, and on a channel this size, I can actually respond to most of you. Your answer also helps me understand what topics matter most to this community, and that shapes what I cover next week. Okay, let's talk about the thing that is on every investor's mind right now. 9 days, that is how long until the single most important earnings report of the year. NVIDIA reports on May 20th. And I don't use the phrase most important earnings report of the year lightly. Let me give you the full picture. NVIDIA generated $215.9 billion in total revenue during fiscal 2026, a 65% increase from the prior year. The data center segment alone accounted for $193.7 billion of that revenue. The company's valuation has grown from $360 billion to $4.8 trillion since the start of 2023. NVIDIA is currently trading around $215. The consensus from 37 covering analysts puts the price target at $272, implying roughly 26% upside from current levels. And Wall Street is getting increasingly bullish heading into May 20th. Goldman Sachs recently raised its EPS estimates by approximately 12% on average. Their updated calendar year 2026 and 2027 estimates are 14% and 34% above the Wall Street consensus, respectively. They expect a beat and raise quarter based on positive industry supply and demand information. So on the surface, this looks like a layup. Strong earnings, beat, and raise setup. AI spending accelerating. What could go wrong? Here is the nuance that separates investors who understand this trade from those who don't. Goldman noted that the bar for stock outperformance is relatively high heading into the print. Let me translate that. When a stock is up 15% year to date, sitting near its 52-week highs with 37 analysts all expecting a massive beat, the good news is already priced in for the stock to actually move higher after earnings. NVIDIA doesn't just need to beat expectations, it needs to beat expectations by more than everyone already expects them to beat expectations. NVIDIA likely would need to deliver revenue growth in the 80% range or greater for its stock to see a real post-earnings pop. Wall Street is already expecting 77% growth. Management guided to $78 billion in revenue for Q1. So the setup is huge expectations, high bar, limited margin for surprise to the upside, but significant downside if anything disappoints. And here is why this matters beyond just NVIDIA the stock. NVIDIA's earnings report will function as a referendum on the entire AI trade. If NVIDIA beats and guides up massively, it validates the thesis that AI infrastructure spending is accelerating, that the cycle has legs, and that tech valuations at current levels are justified. Every AI-adjacent stock, AMD, Micron, Broadcom, the hyperscalers, gets a tailwind. If NVIDIA disappoints, or even just fails to sufficiently exceed the already high bar, the sell-off won't be contained to NVIDIA, it will flow through the entire sector. Now here's something interesting that happened last week that I want you to pay attention to. Wall Street is describing a changing of the guard in AI with Intel, AMD, and Micron surging while NVIDIA lags. All four of those companies have more than doubled in value this year, with Intel leading the way up well over 200%. NVIDIA, meanwhile, is only slightly ahead of the Nasdaq in 2026, gaining 15% for the year. That is a meaningful shift. For 3 straight years, NVIDIA was the undisputed king of the AI trade. Everything else was secondary. Now, the market is broadening, spreading the AI bet across more of the semiconductor ecosystem. In spreading the wealth to a wider swath of hardware companies, investors are clearly betting that the bull market in AI has long legs and that data centers are going to need a wider array of advanced components for years to come. Memory has been the biggest theme of late due to a global shortage that has driven up prices. Micron's CEO told CNBC that key customers are only getting 50% to 2/3 of their requirements because of supply issues. For you as an investor, this matters in a specific way. Faith AI trade is maturing. The buy NVIDIA and forget it era may be giving way to a more nuanced landscape where the gains are distributed, but also where the risks are more dispersed and harder to track. What does this mean for the NVIDIA earnings on May 20? Watch 3 things specifically. First, the revenue number. $78 billion is the guidance. Does it come in at $80 billion? $82 billion? Anything at or below guidance is a disappointment given market expectations. Second, the forward guidance. The market wants to see Q2 guidance above $86.6 billion. Wall Street expects NVIDIA to forecast $86.6 billion in Q2, which would mark an 85% growth rate. But some of NVIDIA's top customers, Meta and Microsoft, have recently raised their capex forecasts significantly, so actual guidance could come in higher. Third, commentary on Blackwell supply chain. NVIDIA's Blackwell architecture represents the company's most ambitious data center chip platform. Early feedback from hyperscalers suggests substantial performance gains over the previous Hopper generation. Microsoft, Amazon, and Google have reportedly placed massive orders, though the timing of revenue recognition depends on shipment schedules that have faced some supply chain constraints. Management's commentary on the May 20 call about production ramp and delivery timelines will be crucial for modeling the second half of 2026. If Jensen Huang says Blackwell supply is ramping faster than expected, that is a rocket ship. If he hedges on supply timelines, expect turbulence, mark your calendars. May 20th, 9 days away. It is the most important date in the market between now and the end of Q2. Let me stay on the AI theme for a moment longer, because there is a trade happening right now that most retail investors are completely missing, and I think it is one of the most important market stories of 2026. Since the launch of ChatGPT in late 2022 and the start of the generative AI craze, one name has dominated the infrastructure boom: NVIDIA. While the chipmaker continues to prosper and is expected to show revenue growth of 70% this fiscal year, Wall Street has moved elsewhere, piling into businesses that were hardly visible in the initial years of the AI build-out. Let me give you the specific numbers. Intel is up over 200% this year, AMD has doubled, Micron has doubled, Broadcom has doubled. These are not small moves. These are historic, multi-100-person gains in established, multi-decade-old companies. Because the market has woken up to the fact that AI infrastructure isn't just about NVIDIA's GPUs, it is about memory. It is about networking. It is about the CPUs running the inference workloads. It is about the power infrastructure keeping the data centers alive. AMD CEO Lisa Su said on the earnings call that AMD now expects 35% growth over the next 3 to 5 years in the server CPU market, up from a forecast of 18% growth provided in November. Agents are really driving tremendous demand in the overall AI adoption cycle, Su told CNBC. Agents, that word matters. AI agents, software systems that can autonomously execute multi-step tasks, represent the next wave of AI adoption. And unlike the first wave, which was primarily about training large models, the agent wave is about fan inference, by running AI constantly, at scale, on CPUs and specialized chips across millions of endpoints. That is the structural shift that is making AMD's CPU business, suddenly, one of the hottest on Wall Street. Now here is the practical question. How do you position for this rotation? I want to be clear that I am not giving you financial advice. I am giving you a framework for thinking about this. The old AI playbook was simple: buy NVIDIA, buy the hyperscalers. Wait, the new AI playbook is more nuanced. Tier 1, the infrastructure core, NVIDIA. Pre-May 20 positioning is high risk, high reward. AMD CPU momentum is real. Micron memory shortage driving pricing power. These are the companies where the earnings growth is showing up in actual reported results right now. Tier 2, the enablers, asterisk Broadcom, networking infrastructure is essential for large AI clusters. TSMC manufactures everyone's chips, benefits from everyone's growth. ASML makes the machines that make the chips. These are less volatile, more defensive AI plays. Tier 3. The AI application layer, asterisk companies actually monetizing AI in their products, not just spending on AI infrastructure. This is where the next wave of winners will emerge, but it is also where the hype to reality gap is widest. Tread carefully here. The key insight is this. The market is rewarding companies where AI investment is showing up in the numbers. Not just in the announcements, the era of stocks going up 50%, because a CEO said, "I on an earnings call" is largely over. Now, you need to show the revenue growth, the margin expansion, the return on the capex. That is a healthier market, but it requires more analysis, and it means the easy money, the buy anything AI adjacent and wait trade, is probably behind us. Outright, I've talked about what is going right. Now let me talk about what could go wrong. Specifically, the 3 risks that I think are being underpriced by the market right now. Here is the macro backdrop that underpins everything else. The Federal Reserve cannot cut rates right now. Full stop. March CPI came in at 3.3% year over year, accelerated from 2.4% in February, with headline CPI rising 0.9% month over month, driven by a 21.2% gasoline price surge. There is no clear basis to signal future easing. April was Chair Powell's last FOMC meeting. His term as chair ends May 15. Kevin Warsh is expected to take the seat on a temporary basis. So you have a leadership transition at the Fed happening right now, in the middle of an inflationary environment with no clear path to rate cuts. Rate cuts are pretty much off the table until well into 2027. Why does this matter for the market right now? Because a significant amount of the January 2026 sector rotation, out of tech and into value small caps, cyclicals, was based on the expectation of multiple rate cuts this year. That thesis is dead. The market rotation that happened at the beginning of the year seemed entirely justified. Tech stocks had been running for the better part of 3 straight years. The Fed was preparing to cut rates multiple times, and when interest rates fall, it provides a more optimal environment for cyclicals, value, and other rate-sensitive issues, such as small caps. But then the Iran war happened, and the outlook changed. The investors who made that rotation bet, they're now sitting in positions built on a thesis that no longer exists. And here is the dangerous part. The Fed can't come to the rescue if markets sell off. In 2022, when the Fed was hiking rates, there was at least a credible Fed pivot narrative that could eventually arrest a decline. In 2026, with inflation re-accelerating and oil above $100, there is no pivot story. If markets drop, the Fed's hands are tied. That asymmetry, we can't cut to help on the downside, should be on every investor's risk checklist right now. I want to go back to the 6-week winning streak, because I think there is something important hiding inside those numbers. Stocks were higher on Friday, bolstered by a stronger than expected April jobs report and hopes for a U.S. Iran peace deal. Hope the market has rallied 6 weeks on hope. Hope for a peace deal. Hope that oil prices normalize. Hope that inflation cools. Hope that the Strait of Hormuz reopens. None of those things have actually happened yet. The market's April rally embedded a meaningful assumption that the Iran conflict would resolve relatively quickly and that energy prices would normalize. The conditions on the ground do not yet support that assumption. Investors should expect continued gyrations in the equity markets as oil prices will remain volatile until we see a lasting resolution. Here is the math problem the market is facing. If the peace deal gets signed this week, how much of that upside is already in the price? We've already had 6 straight weeks of gains on peace deal hopes. If the deal actually happens, does the market go up another 10%, or does it consolidate, having already priced in the good news? And if the deal falls apart, if the nuclear talks hit another impasse, if there is another escalation in the strait, the unwind of 6 weeks of hopium pricing could be steep. This is what traders call a asterisk's buoy, the rumor. Sell the news asterisk setup, but with an additional twist. We don't even have the news yet. We're buying the rumor of the rumor. Here is something that doesn't get talked about enough. Earnings season is the market's favorite excuse to go up. Companies report results. They beat estimates, the stock pops, sentiment improves, and the cycle continues. But earnings season is almost over. NVIDIA, scheduled to report on May 20, is one of the last major tech companies to report. After NVIDIA, we enter what I call the catalyst vacuum, a period with no major earnings catalysts, where the market has to sustain its current levels on macro data alone. And the macro data, as I've described, is not cooperating. Inflation is re-accelerating. The Fed can't cut. Oil is above $100. The Iran situation is unresolved. In strong bull markets, the catalyst vacuum between earnings seasons is just a pause. Markets drift sideways and wait for the next round of earnings. In markets built on hope and geopolitical uncertainty, that vacuum can become a slow leak that turns into a fast sell-off. Watch what happens the week after NVIDIA reports. If the market can hold its gains through late May without a major catalyst, that is actually a bullish signal. It means the rally has genuine legs beyond just the earnings beat cycle. If it can't, that is your early warning sign that something bigger is coming. All right, I've spent a lot of time on risks. Let me be balanced, because the bull case is real and it deserves serious attention. The single most important thing going right in this market is fake corporate earnings. Asterisk asterisk, and I don't mean slightly above estimates. I mean genuinely historically impressive results. The blended net profit margin for the S&P 500 in Q1 2026 stood at 13.4%, the highest level recorded since FactSet began tracking the metric in 2009, surpassing the prior record of 13.2% set in Q4 2025. Margin expansion was concentrated in the information technology sector, which posted a Q1 net margin of 29.1%, up from 25.4% a year earlier. 29.1% net margins in tech. That is extraordinary. That is not financial engineering. That is companies actually making more money on every dollar of revenue than they ever have before. And it is being driven by AI monetization showing up in real, reported financial results. The implication is straightforward. The corporate earnings power that markets are pricing is not a forecast or a forward-looking estimate. It is showing up in actual reported results. That is the foundation, and foundations matter. You can have geopolitical risk, inflationary pressure, and Fed uncertainty. And if the earnings foundation is solid, the market can absorb a lot of those headwinds. There is also the AI capital spending cycle, which is accelerating, not decelerating. Meta raised the high end of its capex guidance to $145 billion. Microsoft announced $190 billion in planned capex for calendar year 2026, well above the $154 billion Wall Street had anticipated. These are not small numbers, these are historic levels of infrastructure investment, and they flow through to NVIDIA's revenues, to AMD's data center business, to Micron's memory demand, to the entire semiconductor ecosystem. NVIDIA has already committed over $40 billion in equity investments in 2026 alone, forging agreements with data center operators, glass manufacturers, AI startups across the stack. The company's $5 billion bet on Intel is now worth over $25 billion. Jensen Huang is building an ecosystem, not just selling chips. And the jobs market. The April jobs report showed non-farm payrolls increased by 115,000, beating forecasts, while the unemployment rate held at 4.3%. Not a strong jobs market, but a stable one. The economy is not falling apart. So here is the honest summary, the bull case and the bear case, or more precisely, the bull case and the warning fake case, can both be true simultaneously. Strong earnings, accelerating AI spend, stable employment, those are real. But they exist inside a macro environment, elevated oil, sticky inflation, no Fed relief, unresolved geopolitics, that could create sharp, rapid corrections, even within an overall uptrend. That is the market we're navigating right now. And navigating it well requires clarity, not conviction. Let me get practical. Here is exactly what I am watching this week and why. Fay Monday, today, oil price at open Fay. This is the canary in the coal mine. After last week's volatility, oil spiked above $106 on Monday, then pulled back to $102 by Friday. Where oil opens today tells you everything about how the market is reading the Iran situation over the weekend. If oil gaps up again, expect a rough morning. If oil holds steady or drops, the rally has room to continue. Tuesday, Fay Wednesday, any Iran mood developments, Fay the 14-point memorandum of understanding, is still being negotiated. If it gets signed this week, markets will likely rally hard on the news, but watch to see if that rally holds, or if it is immediately sold by investors who are already positioned for the deal. The sell the news risk is real. Thursday, CPI Data Watch, unofficial asterisk. Asterisk, while the official CPI print is not this week, watch energy sector commentary, transportation data, and any Fed speaker remarks carefully. Any signal that inflation is re-accelerating from the 3rd of March 0.3% level could spook bond markets and put pressure on rate. Sensitive equities. FAY Friday portfolio positioning. Ahead of NVIDIA FAY by Friday, 9 days of noise will have accumulated. The market will be positioning for May 20th. Watch where smart money is flowing into NVIDIA directly into the broader semiconductor sector or pulling back to wait and see. The options market for NVIDIA heading into earnings week will tell you a lot about how much volatility traders are pricing. All week, the Nasdaq negative 100 level FAY, I mentioned this last week, and I'll say it again. The line in the sand is a weekly close at new all-time highs in the Nasdaq negative 100. If this index breaks out to new highs and closes the week over these highs, this is the clear signal that the market is shrugging off these warnings and mounting a push higher. Until that signal arrives, the weight of technical evidence still points toward maintaining some defensive positioning. Let me bring this home. Here is what I want you to walk away with from today. The market just had its best 6-week run of 2026. Earnings have been genuinely strong. AI spending is accelerating. The jobs market is stable. On those metrics, the bulls are right. But this rally is priced for a peace deal that isn't signed yet. It is priced for oil prices that haven't normalized yet. It is built in an environment where the Fed cannot come to the rescue if something goes wrong. And it is happening 9 days before the most consequential earnings report of the year. And known of that means sell everything and hide. Asterisk, it means have a plan. Know what you own and why, know what signal would change your view, and don't let 6 weeks of green charts convince you that risk has disappeared, because risk never disappears. It just goes quiet for a while before it reminds you, it is still there. Now here is what I need from you, and I am going to be honest about why Faith's channel is brand new. Asterisk, every single one of you watching right now is part of building something from zero. And the way YouTube decides whether to show my content to more people comes down to 3 things: likes, comments, and subscriptions. So if this video gave you value, hit the like button right now. Asterisk, not for me, for the algorithm, because the more people who see this content, the bigger this community gets, and the better the analysis I can bring you every single week. Face a cont. Drop a comment below with one word. Asterisk, what is your biggest concern heading into this week? Is it Iran, NVIDIA, inflation? Just one word. That is it. I read every comment on this channel, and at our current size, I can actually respond to most of you. Your engagement also tells YouTube this video matters, which means it gets shown to more people who need it. Third, subscribe if you haven't already. Asterisk, every Monday morning before the market opens. I am here, not with hype, not with predictions, with data, frameworks, and the clear-headed analysis that helps you make better decisions. We are building this community together. One Monday morning at a time. I'll see you next week.